I want you to think about someone you know. Maybe it's a neighbor, maybe it's a cousin or a coworker or somebody you went to school with. Someone who never seemed to make a lot of money, never drove a flashy car, never talked about the market at dinner parties, never posted anything on social media about their portfolio. Just a quiet person, ordinary life, ordinary income. And then one day, maybe at a retirement party, maybe through a casual conversation, you find out that this person has over $1 million saved, quietly, patiently, without anyone noticing. How did that happen? That question is worth sitting with for a moment, because most of us, when we hear that story, feel two things at once. The first is admiration. The second, if we're being completely honest, is a low, uncomfortable feeling somewhere in the chest. A feeling that whispers, "Why isn't that me?" That feeling matters. Don't push it away. That's the feeling we're going to work with today, because I'm not here to sell you anything. I'm not here to tell you about some system or strategy that will make you rich in 30 days. That's not a speech. That's a trap. And frankly, you're smarter than that. What I want to do is something harder and more valuable. I want to show you what most people get wrong about building wealth, why they get it wrong, and what the quiet, unsexy, deeply powerful truth actually looks like when you decide to live by it. Let's start with the mistake. And I mean the big one. The one almost every American makes at some point and most never fully recover from. We treat investing like it's supposed to feel exciting. Think about how we talk about money in this country. We talk about hot stocks. We talk about timing the market. We talk about someone who put $10,000 into something and turned it into $100,000 in 18 months. We share those stories. We forward those articles. We watch those videos. And quietly, unconsciously, we start to believe that investing is supposed to feel like that. Fast, thrilling, transformative. And so when someone suggests putting $50 a month into a boring index fund, an unremarkable, unsexy collection of hundreds of companies, the brain rejects it. It doesn't feel like enough. It doesn't feel like it's working. It doesn't feel like anything at all. That feeling, that restlessness, that impatience, that need for the investment to feel significant is one of the most expensive feelings a person can have. Because here's what most people do. They wait. They tell themselves they'll start investing when they have more money, when the timing is better, when the market dips, when things settle down. They wait through their 20s. They wait through their 30s. And they wake up at 52 years old with a decent salary, a house that's mostly paid off, and almost nothing set aside for the years when they won't be able to work anymore. The waiting is the wound. The waiting is the mistake, and it's not a character flaw. Please hear me on that. It's not laziness. It's not stupidity. It's something much more understandable than that. It's human psychology working exactly the way human psychology is designed to work. Optimizing for the present, minimizing discomfort, seeking certainty before acting. Those instincts kept our ancestors alive. In the context of investing, they quietly destroy futures. Now let me tell you about something that most people have heard of, but very few truly feel in their bones. It's called compounding. And I know that word sounds like something from a textbook, something dry and academic. But bear with me, because when you actually understand what it means, not just intellectually but viscerally, it changes the way you see time itself. Here's what compounding actually is. It's your money making money, and then that new money making more money, and then all of that money making even more money. Over and over again, year after year, quietly, automatically, whether you're paying attention or not. The mathematics of it are simple. The emotional reality of it is hard because for the first few years, it feels like nothing. You put in $50 a month, After a year, you have a little over $600 plus whatever growth the market provided. After 2 years, maybe $1,300. After 5 years, maybe $4,000. You look at that number and you think, I've been doing this for 5 years and I have $4,000. What is the point? That feeling right there. That moment of doubt, of disappointment, of wondering whether it's worth continuing. That is the exact moment where most people quietly stop. They don't make a dramatic announcement. They don't withdraw the money. They just stop contributing. They get busy. Life gets expensive. And the account just sits there, frozen in time, doing nothing. But the people who don't stop, the people who keep feeding that account month after month through boredom and doubt and market crashes and moments of temptation, those are the people who end up with $1 million. Not because they were geniuses, not because they found the right stock at the right time, but because they stayed, they showed up. They let time do the work that they couldn't do themselves. Let me give you a picture of that. Imagine 2 people. One of them starts investing at 25 years old. She puts in $200 a month and never stops. She doesn't make a lot of money. She's not wealthy by any conventional measure, but she's consistent. She contributes every single month for 40 years, and she earns a reasonable average annual return, something in the range of what a diversified stock market fund has historically provided over long periods of time. By the time she's 65, she has accumulated something approaching $1.2 million, $200 a month, 40 years. Patience. Now the second person. He starts at 35. Same $200 a month. Same reasonable return. But he started 10 years later, so he only contributes for 30 years instead of 40. He ends up with roughly $550,000. Same monthly contribution. Same discipline. Same returns. 10 years of difference. And the gap between them is nearly $700,000. That $700,000, that's the cost of waiting. That's the price of telling yourself you'll get to it later. That is what procrastination actually looks like, measured in real dollars at the end of a real life. Now, I want to talk about something that is, frankly, even harder than starting, and that's staying in when everything in your brain is screaming at you to get out. There is a moment that comes for every long-term investor. You've been doing things right, you've been patient, you've been contributing, and then the market drops. Not a little, a lot. 30%, 40%. You look at your account balance, and it's down by tens of thousands of dollars. Numbers that represent years of your life, years of your discipline, just evaporated on a screen in weeks. And the voice starts, get out, cut your losses, wait until things stabilize, and then get back in. This is different. This time the system is broken. The economy is collapsing. Things aren't coming back the way they used to. Get out. That voice has cost people more money than almost any other force in the history of personal finance. Think about someone who had been steadily investing through the late 90s. They had built up a meaningful portfolio, and then the early 2000s came and the market fell hard, and they panicked. They sold. They moved everything to cash. They told themselves they would get back in once things calmed down, and they missed the recovery. Or think about 2008. People who had been building wealth for 20 years watched their portfolios cut in half. Some of them sold everything at the bottom. They locked in losses that the market itself recovered from within a few years. But they were no longer in the market to participate in that recovery. They were on the sidelines, waiting for a certainty that never comes. Here's the painful, counterintuitive truth. The time to leave the market is almost never when you feel the most urgency to leave. Because by the time you feel that urgency, The drop has already happened. The damage is already done. Selling at that moment doesn't protect you from the fall. You've already fallen. It just prevents you from rising when the market rises again. The people who came out whole, who came out better than whole, were the ones who did the hardest thing, who looked at their account balance in the middle of the worst moments and said, I'm not touching it. Who kept contributing even in the chaos because they understood that a market on sale is not a market to run from. Now I need to say something here, and I want to say it carefully. I am not telling you that markets always go up. I am not telling you that there is no risk. I am not telling you that every investment works out. Risk is real. Loss is real. There are no guarantees in this business, and anyone who tells you otherwise is either naive or dishonest. What I am telling you is that the alternative, keeping your money in a savings account that earns almost nothing, while inflation quietly erodes its purchasing power every year, is also a risk, a quieter risk, a risk that doesn't feel like a risk because nothing dramatic is happening. But over 20 or 30 years, the math is brutal. Inflation is patient. It doesn't need you to panic. It just needs time. The question is not whether to take risk. The question is which risk you're willing to live with. And here's something I want you to think about deeply, because it touches on something most financial conversations skip entirely. The biggest obstacle to your financial future is almost certainly not your income. It is not the market. It is not the economy. It is not interest rates or inflation or political uncertainty. It is you, not in a cruel way, not in a blaming way, but in the most honest, direct, caring way I know how to say it. The greatest threat to your long-term wealth is your own emotional reaction to short-term events. We are not wired for this. Human beings are not naturally designed to watch numbers drop and do nothing. We are not naturally designed to delay gratification for 40 years. We are not naturally designed to stay calm when the world feels like it's ending. These are things we have to choose deliberately, repeatedly, over decades. That's why discipline is the word I keep coming back to. Not talent, not timing, not connections, not inside information. Discipline. The quiet, unglamorous, deeply unseated practice of doing the right thing even when every emotion you have is pointing in the wrong direction. Let me tell you about a different kind of person. Someone who didn't start at 25, didn't start at 35. Maybe they're 48, sitting in a kitchen somewhere, feeling like the window has closed, feeling like they missed it, like the math no longer works in their favor. To that person, I want to say something important. You have not missed it. If you're 48 and you start putting $300 a month into a diversified investment account, not a savings account, not under the mattress, but an actual investment account, and you do that for 20 years, you will have more money at 68 than most Americans retire with. It won't be as much as if you'd started at 25. The math doesn't lie about that. But it will be enough to make a real difference. It will be more than nothing. It will be more than waiting another 10 years to get serious. The best time to plant a tree was 20 years ago. The second best time is right now. That is not a cliche. That is arithmetic. Now, I want to spend a few minutes on something that doesn't get nearly enough attention. The psychological gap between knowing and doing. Most people who are not building wealth, most people who are drifting toward retirement without adequate savings, are not uninformed. They know they should be investing. They've heard about compound interest. They understand intellectually that starting earlier is better than starting later. They know all of this, and they're still not doing it. Why? Because knowledge doesn't change behavior. Emotion changes behavior. Identity changes behavior. The story you tell yourself about who you are and what's possible for you that changes behavior. If, deep down, you believe that wealth is for other people, people with better jobs, better luck, better education, better family backgrounds, then no amount of information will move you, because your actions will always follow your beliefs, not your knowledge. So let me offer you a different story to live inside of. The truth is that the majority of American millionaires are not people who inherited money. They are not people who started companies that went public. They are not people who made one spectacular investment. The majority of them are people who earned ordinary incomes and lived below those incomes and invested the difference consistently over long periods of time. That is not a romantic story. It does not make for good television, but it is the most replicable, most accessible, most honest path to financial security that exists in this country. And it is available to far more people than currently believe it is available to them. The shift I'm asking you to make is not a financial shift. It's a perceptual shift. It's moving from I'll invest when I have more money to I will invest what I have right now, and I will keep doing it, and I will let time do the rest. And here is the practical reality. You do not need a financial advisor to start. You do not need to understand the difference between every type of investment vehicle. You do not need to be able to read a balance sheet or understand price-to-earnings ratios. You need three things: a brokerage account, a low-cost index fund, and the discipline to contribute to it every single month and not touch it when the market gets frightening. That's it. That is the foundation. Everything else is refinement. Now, the amount matters less than the habit. I mean that sincerely. Whether you start with $25 a month or $250 a month, the act of starting, the act of building the habit, the act of making investment a non-negotiable line item in your monthly budget before you spend on anything discretionary, that act is worth more in the long run than the specific dollar amount, because the habit scales. As your income grows, your contribution grows. As your contribution grows, your outcome grows, but it has to start somewhere, and it has to start now. One more thing I want to leave you with, and I want to say it slowly because it took me a long time to really understand it. Patience in investing is not passive. It is not the absence of action. It is not waiting around hoping that things work out. Patience in investing is a deeply active, deeply disciplined, daily choice to not do the thing your emotions are urging you to do. It is a choice to stay in when you want to get out. It is a choice to keep contributing when the balance is going down instead of up. It is a choice to look at a long timeline instead of a short one, to trust decades of historical data over the fear of the current moment. That kind of patience is hard. It is harder than picking stocks. It is harder than reading financial news. It is harder than almost anything else in the investment world because it requires you to override the most powerful instincts you have: fear, urgency, the need for immediate feedback, and replace them with something quieter and slower and far more powerful. And the reward for that patience is not just money. It is freedom. It is the freedom to retire when you want to retire, not when you have to. It is the freedom to weather a job loss or a health crisis without catastrophic financial consequences. It is the freedom to make choices about your time and your energy because you are not desperate. It is the freedom that comes from knowing that the decades of quiet, consistent, disciplined choices finally added up to something real. That is what small investments do over a long enough period of time. They don't stay small. They become the foundation of a life you actually chose. The market will go up and it will go down. The headlines will be terrifying, and then they will be forgotten. Another crisis will emerge and another recovery will follow. All of that is true, and all of that will continue to be true, regardless of anything you or I do. The only variable that is entirely within your control is what you decide to do today. Not in 5 years. Not when the market settles. Not when you feel ready. Today, start small if you have to. Stay consistent no matter what. Think in decades, not months. Let the math do the work that impatience never can. And the next time someone who looks ordinary turns out to be quietly, patiently, profoundly wealthy, it will make sense. Because you will know exactly how they did it. It wasn't luck. It wasn't timing. It wasn't some secret the rest of us weren't told. It was time and the courage to use it.